I personally look at politics and politicians of either stripe with some disdain. I remember well H.L. Mencken's admonishment that elections are advanced auctions of stolen property. And I too remember, I guess it was Gore Vidal, that said that you define politics by looking at the root words, poly from the Greek for many, and tick from the English colloquial for small blood-sucking insect. I suspect that people in life who deliver value to other people, producers, will do well, irrespective of who won the election. I suspect that people who just go through life consuming value rather than creating value will do poorly. The issues around gold and silver, I suspect in the very near term that you will see greater U.S. dollar strength and so softer gold and silver prices. In the longer term, I think that precious metals are a reflection in the maintenance of the purchasing power of the U.S. dollar, which I think will be poor. Remember that the on-balance sheet liabilities of the U.S. government exceed $35 trillion. Remember that the deficits are $2 trillion. Remember, too, that the net present value of off-balance sheet liabilities, Medicare, Medicaid, Social Security, federal pensions, exceed $100 trillion. Harris wasn't going to change that. Trump won't change that. So life will go on. I think that people would like to believe that Trump will solve the malaise around the American economy. And I don't think he'll do that. I don't think he can do that. That's no criticism of Trump. You get elected by making promises to various constituencies. When the bill comes due, it becomes very, very difficult to look after everyone. Those who are hopeful about politics should read a book by David Stockman called The Triumph of Politics that talks about the fact that it took 90 days for the politicians to dismantle the Reagan Revolution. The lesson is to go about your own business, invest in high-quality businesses, generate more utility for others than you consume for yourself. The delta between what you produce and what you consume is called wealth, and you owe it to yourself to become wealthy. I think that markets are maybe not euphoric, but I think, as an example, that Trump will not dismantle the carried interest tax provision, which means that hedge fund operators are happy. Their taxes won't go up. I think that Trump absolutely will deliver tax cuts. And for upper income taxpayers such as myself, that's lovely. But tax cuts without spending cuts are actually fraud. They defer the bill. So in the near term, the liquidity from tax cuts are a good thing. In the long term, they add to the on-balance sheet and off-balance sheet liabilities of the U.S. government if we don't cut spending. And I don't believe that Trump or anybody else, this isn't a criticism of Trump, I don't believe that any of these people have the wherewithal to cut spending. The message is to pay attention to the basics, not to be despondent, not to be elated, not to worry too much about a floating abstraction called an election, and spend a lot more time paying attention to the companies that you invest in, paying attention to doing your job well, and paying attention to running your own business well. What I've learned in life, both as an investor but as a lender, is that asset values are ephemeral. They rise and fall, but obligation, debt, is fixed and money good. Specifically, the debt to GDP number is relevant because it means that if we had the replay of a circumstance like 2008, a liquidity crisis, our ability for credit markets to allow us to print our way out of the difficulty, to increase liquidity through quantitative easing, gets less and less. Coming into 2008, federal debt, on-balance sheet debt, relative to GDP was about 40%. That same number today is 3 times higher. The tolerance of credit markets for counterfeiting will decline, which means that our fiscal ability to deal with liquidity crises declines. Could it work one more time? Sure, maybe. Maybe's a rough word. It's all a function of confidence. We could afford to be more confident when on-balance sheet liabilities were 40% of GDP than we can where on-balance sheet liabilities are 120% of GDP. But people look at these numbers and they think they're abstract. Let's transpose those to a person. Let's decide that your gross earnings for a year are going to be $100,000. And let's decide at the beginning of the period that you have $40,000 in debt. After all of your other expenses, you can likely service $40,000 in debt at a reasonable interest rate. Let's say that, however, 20 years hence that your salary is $100,000 and your debt is now $120,000. Sometimes it's useful to scrape all of the zeros off the number and to personalize the potential impact of the debt. Sometimes that helps people. But the second area of concern goes around a number that nobody talks about. That is the $100 trillion in the net present value of promises that we've made to ourselves, entitlements. I believe that we will honor the nominal value of those entitlements. Let me put that in perspective. Some old codger, let's say Rick Rule, a 71-year-old guy, I don't know what Social Security has promised me, maybe $4,000 a month, I don't know, $3,000, I have no idea, to be honest with you. Society's going to keep that promise. They're going to continue to pay me my $4,000 a month, but they're going to inflate away the net present value of the obligation. Did you know that in the decade of the 1970s, according to the IRS, the purchasing power of the US dollar in 10 years, 1970 to 1980, declined by 75%? I believe that Medicare obligations on a nominal basis and Social Security obligations on a nominal basis and federal pensions and military pensions on a nominal basis will be honored. But I think the purchasing power of those nominal payments will be reduced by 75% in the next 10 years. In other words, some old codger like me will get $4,000, but $4,000 will buy $1,000 in goods and services. That's how we'll deal with the debt and the deficits. So be prepared. I would argue that we've already seen the return of inflation. The big thinkers in the world would have you measure inflation as the CPI. We laughingly call that the CP lie. The CPI, when it's inconvenient, doesn't include food or fuel. What use is an inflation measure that doesn't include breakfast, lunch, or dinner? The second thing it does is it doesn't value the cost of goods and services. It assigns arbitrary value to them. It is hedonistically adjusted, meaning that the people who construct the index construct the values. But the silliest part about the CPI is it doesn't include tax. I would ask your listeners to do a thought experiment. Take the period, if you will, 2000 to 2024, and ask yourself whether your cost of living has increased at 2.6% or some higher number. I would suggest that if you measure inflation personally and you describe it as the deterioration in the purchasing power of your savings and investments, that the purchasing power of the US dollar is declining by more like 7.5% compounded. Over the last 4 years, has gasoline gone up 2.6%? Have grocery prices gone up 2.6%? Has health insurance and healthcare gone up 2.6%? How about rent? The mortgage interest rate has doubled. And how about taxes? The idea that inflation, as I define it, the deterioration in the purchasing power of US dollar savings, is marching along at 2.6% is to me farcical. I'm amused that the people who vote and the people who work and invest now believe that these inflation measures, by measures, I mean the methodology that's used to measure inflation and index, is accurate because it's fiction. This isn't a Democratic statement. This isn't a Republican statement. This is simple arithmetic. Inflation is with us. We are in a circumstance that left to its own devices would be broadly deflationary. When you liquidate at the end of a credit cycle, when you have defaults, that's deflationary. The policy response to that is inflationary. In other words, we postpone the reckoning around the debt by inflating away the net present value of the debt. We're living in an artificial construct, and I think we're going to live in an artificial construct for the rest of my natural life. What that means as an individual is that you need to understand if you are on a defined benefit pension plan, or if you think that your university education in the future is going to be funded by an endowment. If you're counting on Social Security or Medicare or Medicaid, understand that you're going to have to make other arrangements. If you are planning for retirement, if your thinking is around nominal pricing, which is to say, if you have an adequate life now with retirement income of $5,000 or $6,000 a month, and you project forward 10 years, understand that your $5,000 or $6,000 a month will buy you $1,500 worth of goods and services at today's prices. looking forward. And you need to make private arrangements to deal with that. And it's important that you begin to do it now. According to government statistics, the US dollar lost 75% of its purchasing power in 10 years. Not coincidentally, the gold price soared. I think it's important to note, too, for all its faults, the US currency is still the best currency in the world. So if you live outside the US, my suspicion is that your outcome will likely be worse, not better, unless you live in demi-states, Singapore, where you do, as I understand it. But for Americans, I'm not suggesting doom and gloom. I'm just suggesting that if you rely on the Commonwealth in the old-fashioned sense of the word for your future, you're mistaken. You need to rely on yourself. I think the dollar will do well relative to other currencies, but I think the dollar will do very poor in isolation. Let's look at the arithmetic around the U.S. 10-year Treasury. The Treasury pays you 4.4%. And if you believe the CPI stated rate of inflation at 2.6, you're getting a 2.2% real yield. Not great, not bad. You know you're going to get paid because if they need to, they can print to pay you. But if you change your inflation assumptions to reflect real arithmetic, what you see then is that the purchasing power of your yield and your principal is declining by 7.5% compounded. Now that's brand new arithmetic. If you take 4.4 as the interest number and you subtract 7.5, the deterioration in the purchasing power, what you learn is that in a real sense, you're losing 3% a year, every year for 10 years. The U.S. government is making you a promise. If you lend them $1,000 today in a U.S. 10-year Treasury, they will give you back 35% less purchasing power 10 years from now. And they guarantee it. That's the first promise they've ever made to me that I believe. I think they're going to be under an awful lot of pressure to either maintain or cut the interest rate. The political clamor from both sides of the aisle is cheaper credit. In other words, penalize savers on behalf of spenders. In a sense, the political class has no choice. With almost $36 trillion in on-balance sheet liabilities, an increase in the nominal interest rate leaves less money in the federal government for them to waste. And that's what they want to do. So my suspicion is that interest rates will either stay the same or they will engineer 25 basis point rate cut. I don't believe that we will see an end, perhaps even in my lifetime, to artificially low interest rates and credit market manipulation by the Fed. Let's look at what manipulated interest rates are. They're really a political circumstance where you penalize savers, people who have generated economic surplus, on behalf of spenders, or on behalf of relatively few investors like myself who have access to credit and the knowledge to employ it intelligently. What it really is an income transfer from those who save to those who spend and invest. It amuses me that it's so popular. I think we're in stagflation. We have an economy that is much stronger than I had anticipated, but it's an economy that isn't working for most Americans. It's working in spades for people like me. This is really truly a Goldilocks moment. The jobs growth that we have seen statistically is almost all government jobs, which is to say no wealth creation, just wealth redistribution. We have papered over the excesses in the economy, but what people really seem not to understand is the deterioration in their purchasing power. It's even become a political issue. Groceries, food, which is 11% of the average household budget, has become a political issue. It is not that grocery prices have gone up. It's that the purchasing power of the dollar has gone down. The profit margins for grocery chains are notoriously small. Gasoline prices rise and fall in some measure due to crude oil prices. They also rise mostly due to the difficulties around permitting new refineries. What rises inexorably around gasoline are taxes. I think what we have is a situation like we had in the period 1968 to 1972 or 73, where the impact of inflation hadn't been personalized, which is to say that people hadn't recognized it yet. And I think that we're 1 or 2 years away from a popular reckoning around inflation and an understanding like we had in the 1970s that this isn't a problem that can be solved in a quarter. It's a problem that needs to be solved over a decade. And we will solve it, by the way. It's just that it's going to take a really ugly period of readjustment, much, I think, like the decade of the 70s. We are not headed to stagflation. We're in it. in the early innings, to be sure. And it hasn't impacted markets yet because people went through a period, 1982 to 2022, a 40-year period of very benign economic climate. And people's perceptions of the economy are set by the experience over the last 40 years. I would argue that beginning in 2022, things changed. And I think that the pace of change will become increasingly rapid. I think that'll be very good for people who understand it and are prepared for it, which unfortunately I think is a small proportion of the population, and very bad, like the decade of the 1970s were, for people who didn't prepare themselves.